tax advantage savings is the next way. So everybody says we went through the basics of what we want to do. We went through how we kind of crunch some of the numbers, some of the general mechanics on how we do things, and now we're going to use the different products or accounts to get us there. And so there's some tax advantage savings vehicles you can utilize to save for retirement. And so really the best way to save for retirement is through these tax savings vehicles. And so some of these is a 401k is considered a tax and saving, is considered tax advantaged. There's other employer-sponsored retirement plans, profit sharings, different things, but those are all considered, tax advantage. A traditional IRA is also tax advantage. A Roth IRA is after tax, but it's still tax advantage. So when we say tax advantage, we say, anything that gives it some specific tax break, either pre-tax or after tax. And so traditional 401ks feature tax-deferred earnings growth and can lower your current taxable income right now, but later you'll pay taxes later, and we'll get a little bit farther into that later. And so what we're going to do is next few minutes is spend a few minutes looking at the impact of tax-deferred growth also has upon your account, and then we'll talk about 401ks, traditional IRAs, and Roth IRAs in more detail. And so when everybody talks about tax savings vehicles, if you had an account that you had $20,000 invest, and we're going to split that $20,000 up into two pots. One's going to be a taxable account, and one's going to be a tax advantage account. And these both earn 6% a year, so it maintains everything constant. And so you're using a portion of these assets to pay taxes through the earnings, and the other one, like I said, you're putting into the tax deferred account at 401k. So assuming that you're in the 28% tax bracket, in 30 years, that $10,000 you put in is going to be worth $57,435. Now that shows you the power of tax deferred growth. The other one that you still put $10,000 in and paid taxes during the years is only worth $35,000. And so really, and I guess if it's $57,000, but if you want to compare the apples to apples, after you pay the 28% tax, the one that's the tax deferred growth is still worth $41,000 as opposed to the traditional or the taxed vehicle of $35,000. So you're still $6,000 ahead on a tax basis standpoint by using some type of tax deferred vehicle. And so that just kind of gives you an idea how that tax advantage can help you. That power of that compounding of interest each year can help when you're not paying taxes and it's eating away at a portion of the earnings, because you're having more and more of your money work for you each year, not go towards taxes.